Good morning, everybody. Welcome to today's 1 million by 1 million strategy roundtable for entrepreneurs. 1Mby1M, as you know, is the first and only global virtual accelerator for technology startups. And this is global. We get entrepreneurs from every corner of the world. And this has been going on for a very, very, very long time. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. And in support of that mission, we've been doing these free mentoring roundtables for a long time. Maureen, I am not able to advance the slides, so you're going to have to do that. This is the 711th 1M by 1M roundtable for entrepreneurs. We started doing these in 2008 as an experiment, and it has been an amazing experience working with entrepreneurs from every corner of the world. And we've just learned what's going on in different parts of the world and really remote corners of the world. Just recently, I don't know if it was last week or the week before, one of the pitches was from an entrepreneur in a far eastern little state of India that is in the Burma-Myanmar border, which is kind of war zone, so it was so moving to see that these people found their way to us. We don't really market to, these kinds of, we don't do any specific marketing. So they're finding us and coming here and working with us. These are working sessions. So it's really been moving and wonderful to do this for a long, long time. Maureen, could you advance the slide, please? Recently, we have introduced an AI mentor to make our program more scalable. It has been scalable for a long time, but not at this scale. Now, the AI mentor is trained in 20 years of my mentoring sessions, writings, videos, lectures, courses, books, everything. And that is now available for you 24/7, safe, private. So you can go try the AI mentor out, and you can basically get very far, I think, with this product. It's an additional product to everything else that we offer in the program. I'll go over all that at the end of the session. Next slide, please. Today, we're going to start our session with a conversation with my dear friend, Gus Tai, whom you've seen here many times, because Gus and I are, sounding boards for each other on many, many, many topics. And every year we do a few of those sounding board sessions in public at these roundtables. So we kind of talk about the topics that we want to kick around with you guys, so that you guys can also, be part of that kind of brainstorming. And that's what we're going to do today. The last few years, it's been at the end of the year that we do kind of like a recap and exchanging notes on the year. Gus, welcome back. It's great to have you. And I'm sorry we have a bit of technical issues this time.
Oh, so wonderful to see you, Sharmana, and no worries at all about these technical complications.
So we're going to start with a hairy, controversial topic. And my conclusion is that the venture capital industry is way too big. There are too many firms, and it's causing problems. Let me frame this conversation segment for all of you so that you can follow along. We've had a hyperactive venture capital industry since the mid-90s, when the internet first came into being as an engine of innovation. In 30 years, the industry has accumulated enough data to show that the vast majority of VC-funded startups fail. Absorb that. Some fail altogether. Some succeed in building customers, revenues, profits, but are slow growth. They're not growing exponentially. They're not going from 0 to $100 million in 5 to 7 years. And their exit prospects are not in line with the amount of capital that they have raised. So what happens? They become zombies. And yet, entrepreneurs still believe entrepreneurship equals financing. They mindlessly chase venture capital and raise money without a clear idea of how they plan to build a high velocity, hyper growth, exponentially growing company. And in our industry, dumb money abounds. I would say the vast majority of venture capitalists do not understand venture capital. They don't know what they're doing. So they set hundreds of thousands of entrepreneurs up for failure by investing in them. But if you take venture money, you have to grow at venture pace, which is $0 to $100 million in 5 to 7 years. So this is a problem. This dynamic is a real problem in the industry. And what I want to start with today with Gus is to kick around this particular issue and brainstorm about how to change that. Gus.
Oh, for sure, Shamana. And there were a couple slides. I don't know if you were going to cover those now or cover them later regarding the cyclicality of venture.
Maureen, could you move to the next slide? Yes. So Gus sent along a couple of very interesting slides with some data. So it is actually true that the number of active VCs has dropped since 2021, which was the peak of the industry. Gus, how do you read this slide, and what color do you want to provide to this?
Yeah, for sure. And so I guess for context, I think it's important to remember or to observe that venture capital is a cyclical industry, and that there are times when there's too much capital, relatively speaking, and there's times when there's not enough capital. I would say that leading up to COVID, there was too much capital. And this slide that you can see highlights that from the great financial crisis until COVID, there was an increasing amount of dollars flowing into venture capital, which allowed an increasing number of venture firms to be created. So going back 10 years, according to PitchBook, in 2014, there were about 3,000 active venture firms, which means, and this is probably North America, which means that they would make at least one investment a year to define active, and many would make many more. That number almost tripled from 2014 until 2021, at which time there's about 8,200, 300. That meant that during that period of time, there's 3 times as many firms making a large number of investments. And going back to some of the themes Sharmana is highlighting is how skillful were these venture firms at helping the venture companies that they're funding during this period of time. And then since COVID, the number of active companies has dropped by 1,000 firms a year, more or less, and that they're perhaps not being able to raise additional funding. Perhaps they're looking to stop being in the venture business. But it highlights that there was an excess supply of venture firms relative to dollars and relative to startups out there. And so this is highlighting the cyclicality that in boom times, things really go boom, at which time folks may not be as skillful as you would like. And then we're going in the direction.
One of the interesting points is the peak of this is 2021, which is the peak of COVID. So not exactly boom time in the, not traditional sense of the word, but somehow or the other, the venture industry peaks in 2021, 2022, which is the height of COVID. You have.
And the next slide, Sharmana, I would also want to comment, and then we could go into the broader discussion.
You have the next slide, Maureen.
Yeah, Maureen, if you could move to the next slide, which has the amount of this chart is a complement to the prior chart. But the reason I wanted to highlight this one, this is also coming from PitchBook, is that in if you look at this, this is the amount of dollars that are being raised by venture firms, and it actually peaked in 2022. So the prior slide was around the number of investments, number of venture firms who are active in making investments. This is the venture firm raising money. So the peak amount was in 2022, and it's plummeted from 2022 to 23, 24, 25. Note that 2025 is for 3/4 of the year, not the whole year. But in 2024, that large bar of which I would say $80 billion has been raised, in that year, which is our most recent complete year, if you think about the Pareto of how many dollars went to funds, normal Pareto, you'll hear about 80% is done by 20% of the participants, or 80% of the outcome is result of 20% of the work. In venture in 2024, 75% of the dollars went to 30 firms. That's a 75%. The Pareto here is 75-4. 75% of the dollars went to 4% of the funds raising money. And you would say 30 firms, these firms, if they're raising annually, on the prior slide, there's 6,000 active firms. So 30 firms are collecting the bulk of the money. Venture is fundamentally different today than it was 10 years ago. And so the themes that Shimon is highlighting apply to many of the venture participants, but I would say that one major difference is there's this institutionalization of very, very large firms that have a lot of assets under management providing different types of services.
Which changes the nature of venture capital. We have seen in the last few years, especially 2023, if you see the this chart, 2023 is kind of the point at which generative AI, the mania starts, really. ChatGPT hit the market in 2022, but the mania hit the market in 2023. And at this point, these mega investments in some of the very large LLM companies and, like Anthropic and OpenAI and Mira Murthy's company, Thinking Machine Labs, which with no product, nothing, is valued at billions and billions of dollars. So that phenomenon of what we call the hyperscalers kicks in high gear, and the fundraising is showing that behavior, right?
Yeah, well, it's showing it's showing this barbell effect that we're hearing about mega rounds of companies at mega high valuations. And those are predominantly being funded by these top 30, 50 venture firms that have large pools of assets under management. It's a different type of business compared to having $500,000 or $1 million or a couple $1 million allocated to a bootstrap team or to a team of 5 people.
Yeah, and those large 30 funds are not playing that game anymore. They're not really investing in these little companies that are going to grow in a more disciplined way. They are really going for a very different kind of venture capital, which is basically very fat startups that start off with huge amounts of capital. And that kind of capital is, it turns out to be one of the moats, because very few people can raise that level of capital. And so a few startups basically dominate that part of the market.
Exactly. And even in this time of big funding rounds, it's probably harder to raise money if you don't have a company that fits into that model.
Which comes into another part of this discussion. We are, just as this thing is happening of these very, very, lavishly funded companies, there is another phenomenon that is running parallel to it, and that has really hit high gear this year, which is, this is also the golden age of bootstrap startups. People are getting a lot more done a lot faster with a lot less resources, a lot less capital this year than ever before. So we are seeing trends like ultralight startups, solo entrepreneurship, bootstrapped entrepreneurship really kick in high gear. And there comes a different question, which is, once you start hitting that kind of, really nice growth as a bootstrap startup, let me give you the example of Lovable. Lovable, I think probably all of you have read about Lovable, which is an incredibly fast-growing no-code software development platform, app development platform that is really going gangbusters this year. They went from $0 to $200 million, I think, bootstrapped, and then they raised a lot of money at a very high valuation. And I looked at that and I kind of had the impression that this may not work as well as a venture-funded company. And the reason being, you know, in these no-code companies, no-code platforms, there's a tremendous amount of experimentation going on. You know, it costs like $20, $30 a month. People subscribe, people start writing some apps and then tinkering around with those apps. It's not necessarily the case that this revenue, let's say you have 200 million revenue, it may not be 200 million ARR, you know, or whatever, you know, 50 million, whatever level you're operating at. Just 50 million revenue may not mean 50 million ARR, because you don't really know what kind of churn you're going to experience, what is the stickiness of the customer base. So churn tends to be high in these. What I'm hearing from everybody is that churn is very high in many of these companies. So if you raise money, a lot of money, without figuring out what your actual churn rate is going to be, then you're not going to be able to sustain the growth. So Gus, let me turn this back to you to comment on how does that scenario play into the venture dynamics?
Yeah, no, Sharmana, I think you're highlighting perhaps the most important question an entrepreneur should have, and that is, what really are the specific needs the customer has that I could deliver in a way that's economic and delights the customer? And if the customer is only temporally interested in novelty or curiosity or testing, that's all well and good. But if you build a company assuming that novelty and curious behavior becomes sustainable, then that creates a complication. So venture dollars can be helpful if you know your model works, because you're super close to the customer and you're looking to scale what works. I think that in the period we're in, I would just highlight that to be cautious about confusing novelty for real enduring value creation for the customer. And the beauty is that it's a lot cheaper to do testing. So I like the model of staying lean and refining the model before scaling.
So I have another actually very contrarian perspective on this topic, Gus, which I want to share with you and hear what you have to say. VCs have to build companies, or VCs have to help build companies. So the value creation for VCs is not in the cash that's being generated. It is in the valuation of the company at which it's eventually going to go public or get acquired. It's the company has to become, you know, sustainable and exitable. The main thing is exitable. After that, what happens is not the concern of the VCs, but it has to be exitable. And up to the point that it exits, it has to be growing at a fast pace. Otherwise, it's not going to find a good exit. The entrepreneur, especially the bootstrapped entrepreneur's perspective, is slightly different. For the bootstrapped entrepreneur, cash is king. So let's say you get into the market and, okay, people are testing your software, and you suddenly see a hockey stick in revenue, and you have cash flowing in. That is a great situation, because that gives you ammunition with which for you to experiment. My take is that cash is really helpful for you to figure out what you want to do with it. The platform on which we are doing today's session here is Zoho. We just switched from WebEx to Zoho. And we've been using Zoho in other parts of our organization, and we wanted to integrate with those. That's why we brought Zoho into this, the roundtables. This is a company that started as a little network management software company. And it was little. But it was a cash cow it was a little cash cow. It was generating maybe $5 million a year, not growing fast, but it was generating, very profitable cash. And Sridhar Vembu, the founder CEO of Zoho, used that cash to experiment with the CRM software that was a competitor to Salesforce.com. And this was the mid-2000s. And that product was offered to the market at 1/6 of the price of Salesforce.com. And that got Zoho into the market explosively. And it turns out that their revenue for Zoho was enduring revenue, and they have layered product after product on top of that portfolio. And they have probably 20, 30 products in that portfolio, all very affordable, going after the small business really. And it has become a very large $1 billion plus bootstrapped enduring business. But remember what I said, there was this cash business in the very beginning that gave them the seed capital with which to do all this experimentation. So for those of you who are building bootstrapped businesses at the moment, taking advantage of this golden age of ultralight startups, experimentation, bootstrapping, LLM wrappers. LLM wrappers are everywhere right now. We're doing all kinds of things with LLM wrappers, and those are great, tools with which to experiment and build fast growth businesses quickly. May not be enduring revenue, but it could be cash with which you can do other things. So there is the venture perspective, for whom churn is a huge problem, and you should not raise venture money without establishing that your business is an enduring business. But if you are doing experimentation and some product is hitting the chord with some segment of customers and throwing in a lot of cash for you, by all means, keep collecting that cash, because that cash is going to give you lots of optionality. Yeah?
Yeah, Shriman, I was taking and appreciate the perspective, because it made me realize that so venture capital is a financial resource, and it's really helpful for the case where you want to scale quickly for whatever reason. But it's a type of finance where, in short, venture capitalists buy low, sell high. That's the driver of the business as a finance business. So you as an entrepreneur, if the resource is helpful for you, you could purchase it by selling your shares and use that resource. The dilemma, I think, today, or the opportunity today, is that I would say, whereas in the 90s, in the early 90s, the entrepreneurs bootstrapping a business was more expensive, and venture capitalists didn't have as many opportunities for what they wanted to deploy their capital against. They would actually fund venture. They would actually take on risk of formation of a company of people with some ideas and do that. And there's high infant mortality, but high upside from that. Fast forward to today, the vast majority of venture dollars are going to different types of companies, in particular these AI large capital intensive businesses where capital is a moat. And it may not be as suitable for these large venture firms to do the venture capital of very small companies. And at the same time, it's a lot cheaper to bootstrap a company. So I would just say that why not bootstrap a company and pay attention to how your rate of learning and how you want to apply that learning. And venture, when you get to a certain scale, will be available if you're showing that revenue growth rate against something enduring. But to look and spend a lot of time to raise venture capital early on, it's probably more difficult, especially when it's so much cheaper for you to do your own experimentation.
So Gus, that is a very good segue into the other class of venture capital companies that are in the market. Those 30 funds that are raising mega capital and doing these mega deals, let's take them out of the loop. But there are many other companies, and actually there's a very large seed capital, pre-seed capital, post-seed capital kind of focus venture funds out there. And a lot of the problems that I talked about at the opening of this session, which is, people are investing things that should not be invested in and setting entrepreneurs up for failure. Those are the culprits of that behavior, right? They invest in things, and many of these VC funds don't have the quality of deal flow that is venture worthy, but they have to invest. Otherwise, they haven't been given capital by their limited partners. Some of these are very small funds, but if they don't have deal flow, they still invest because they have to show to their investors, limited partners, that yes, they are investing. And a lot of companies which should never have raised venture capital are going and raising venture capital, and that is a real shame, because some of those companies as bootstrap businesses would have succeeded in building sustainable companies. Instead, they become zombies.
Yeah. So I guess the way I view that is that there's a marketplace where venture is a resource, and I would say that in the 90s and the noughts, there was a lot less understanding of what it meant to take on new stakeholders. So when you raise venture capital, you're bringing on new stakeholders who have interests that are aligned with yours, but also interests that are different. When you have a partnership with anyone, they'll have different views. And I would say that there's a larger gap of misunderstanding decades ago. And I'm hopeful that today, entrepreneurs, through education and through insights such as what you're providing, Sharmana, are going to be more informed about what it means to take on a venture capitalist as a partner. So I would not characterize the venture industry as causing startups to fail. I would just say partnering with venture capitalists could make your goals more complicated. And if you have a viable bootstrap business, it will be different if you raise venture capital, and just realize that. And so are you informed about taking on this resource and taking on these partners?
I wish I could say to you, Gus, that we are succeeding in educating the market better and away from this entrepreneurship equals financing point of view, but we're not. In these sessions, I'm constantly encountering entrepreneurs who should not raise money, who should not even think about raising money. They're all chasing venture capital mindlessly. And the buzz around capital raising is so dominant in the startup industry that entrepreneurs with not much understanding of what the hell they're doing come into the startup business. They decide they're going to do a startup, and they immediately think, oh, now I need to go out and raise money. This is actually the dominant theme, dominant thought process of startups. Unfortunately, we have no way of countering it so far. Yes, 1M has been one of the loudest voices countering this problem. And we have gotten some distance. We have built a lot of successful bootstrap companies and encouraged a lot of successful bootstrap companies. But I think we are really swimming against the current, and it's not easy to swim against the current that is that powerful around the world. So that's, I would say that is a disappointing conclusion that we have come to after doing this for 20 years, actually. So I've been countering this current for 20 years, and it has not been an easy thing to accomplish. We have had some.
I think, Sharmana, so what you were highlighting is, to me, the way I receive that, and it makes sense to me, is the nature of the human nature is of a certain type of property, and without experience, then that would be the tendency. I am curious in that I agree with you that we're in this golden age of bootstrapping, a golden age of solo founded companies. And even Carta, which manages a lot of venture-backed companies, highlighted that that the number of solo founded companies registered on Carta has grown 50% as a percentage of solo of companies in the last 5 years. And so if it's cheaper to do experimentation, perhaps you'll see a shift, but I agree that human nature is what it is, and so there's fighting against the tide, but nonetheless it's a valuable resource to share this information to cultivate wisdom in people.
So you said two things there that I want to elaborate on a little bit, and I know we are almost at the end of the time that we had allocated. Human nature is, as you have pointed out many times, is status seeking. And the status until now has been in venture funding your startups. Venture funded startups think they are much higher status than bootstrapped entrepreneurs. And the media treats bootstrap entrepreneurs poorly. Sridhar came to see me in 2007, and in my living room sitting, I remember still vividly that conversation. He said, no media wants to cover because I have not raised venture capital. And I was stunned by what a fantastic story it was. I did the first story on Zoho. I wrote about it. There's an interview on my blog that you can still go and see. And then I wrote the first big story about Sridhar Vembu and Zoho on my Forbes column. And that's how the world found out about Zoho. But it was stunning to me that the media had no understanding of a really high-powered bootstrap entrepreneur and how much potential that company was showing. They just didn't know how to read it. But that is starting to change a little bit. If you go to LinkedIn right now, LinkedIn is full of AI slop, but LinkedIn also has some entrepreneurs bragging about how well they're bootstrapping. And that's a good thing, because that's coming from the horse's mouth. What we have done here is we have done case study after case study of entrepreneurs telling their bootstrap story and bootstrap success story, or bootstrap first, raise money later success story, bootstrapping with a paycheck success story, solo entrepreneur success story, bootstrapping using services success story. All of this is helping generate awareness. And I think I'm thrilled that this Carter report of 50% increase in solo entrepreneurs is happening. We have supported solo entrepreneurs from day one, but these poor solo entrepreneurs have faced so much bias. The accelerators don't want them, the VCs don't want them, everybody wants a co-founder. Well, the truth is, getting along with a co-founder is not so easy. Marriages break, but breaking up your co-founder, divorcing your co-founder is not an option. It sits on your cap table, and you cannot restructure your cap table. You can get divorced, but you cannot restructure your cap table. And, getting along with another human being with no hierarchy at the exact same level, equal co-founder under tremendous amount of stress is very, very difficult to do. So it's, yes, it is lonely to be a solo founder, but it doesn't have to be lonely. You have your team. You build a good team. If you're a good manager, good leader, you can lead a good team and you don't have to be lonely. It's having a co-founder doesn't necessarily mean that you're so, well supported and so forth. So these are, biases that are there, and it's great that performance is going to speak for itself. I think we're going to see a lot of solo founders doing really, really well. We've already seen some very interesting solo founder companies. Base44 was completely solo founded in 6 months, got acquired by Wix for $88 million. We've seen, ServiceNow, which is a mega multi-billion-dollar company, one of the best companies that have come out of the whole SaaS revolution. That was a solo founder. I interviewed him in 1999, Fred Luddy, and he was a little company at the time, and I found him to be amazing, absolutely. So that's a solo founder who built a team and built a fantastic company. So there are tons of solo founders who are doing great. So if you're listening to this as a solo founder, please take it as complete and unambiguous support. We support solo founders, and we will figure out how to help you succeed, and including raising money. As soon as you start showing performance and metrics, you are fundable, solo or not. It doesn't matter. So, Gus, is there anything else? I know we are out of time, but is there anything else you want to add to this discussion on?
Yes, I would want to just say one thing, one major theme I would just call out that would, in my mind, wrap all of these topics together. And that is that the broader theme for the opportunity for entrepreneurs to have an edge today is to really embrace how disruptive AI is and what discontinuities will arise, including how much easier it is to set up a company and experiment and test. So whereas in the late 90s, it was hard to be a solo founder for lots of different reasons, and you needed resources like a lot of cash to run data centers and build out infrastructure. Today, I think that the pressure of AI causing traditional jobs to be redefined makes it incumbent upon all of us to think about ourselves as sole proprietorships. And as we as sole proprietor, SMEs, how do we use AI to augment our team? And then, of course, it's helpful to have other human employees and participants and bring them on board at the right time. But to kickstart, really know who you are, what edges you may have, and augment that and amplify it using AI, and see what might arise. So I think maybe we're at a turning point that 5 years from now, Shimano will be like, yeah, of course you want to be a solo entrepreneur initially, using AI in a bootstrapped way to understand what people really need. Right. So that would be a wholesome way to view the world.
We went through a little bit of this shift in COVID, actually. We, as you know, we have always been a virtual company since 2010, which was very early to be a virtual company. But by 2020, when COVID hit, everybody started becoming virtual companies. So there was no stigma against virtual companies. There was a stigma against virtual companies before. That started going away. Now there is less stigma against virtual companies. I think solo entrepreneurship is going to go through the same kind of transition. And as a matter of fact, AI is there's going to be so many fantastic solo entrepreneur-led AI companies, AI boosted companies, whether it's AI company, mostly it's AI companies. But I mean, in our organization, the amount of productivity we're experiencing because of AI, Gus, is amazing. And of course, we know how to use AI, which is where you need to get to. If you want to be a solo entrepreneur, you absolutely need to get to, training your organization to really be an AI first company. And that's amazingly feasible, amazingly fantastic. So on that note, Gus, thank you. It's a controversial topic. I think what we are saying is, to net it out, we are saying the number of VC firms needs to go down. The number of dollars that are going into venture capital needs to go down. Solo entrepreneurs need to be supported. Bootstrapping needs to be supported. Virtual companies need to be supported. So all these are against the current of the venture capital industry. So, oh, by the way, one more, accelerators. We are a non-equity accelerator. We've been a non-equity accelerator from the beginning. And I believe that accelerators should not charge equity, which is completely contrarian to how this industry operates. Okay, thank you guys for coming, and I will catch up with you soon.
Shramada.
Bye. Maureen, can we have the next slide, and we'll shift to our entrepreneur pitch session. Folks, this is a safe working session. You don't need to be nervous. You don't need to be defensive. We are on your side. We're just going to work together and see, how we can add value to your journey and help you accelerate your journey. Maureen, next slide, please. If you disagree with my feedback, that's okay. This is your venture. You do what you want. I'm going to give you candid feedback, and then you do what you want with it. Next slide. Let's see who is going to. Okay, Abdul Hadi, are you in the room? I see Abdul in the room. His microphone and video are not turned on. Let me see if I can I have turned your controls to talk with video. So Abdul, you should be able to unmute your video, unmute your audio, and turn on your video if you'd like. Could you do that? So it's going to be Abdul and then Kosmas are our two presenters today. So Abdul first and then Kosmas. Abdul, are you planning to turn on your video? You need to turn on your audio. Even if you don't turn on your video, you need to turn on your audio.
Hello?
Yes. Hi. Maureen,
Hi.
could you give us the slides, please? All right.
Hello?
Hey, Abdul, you are streaming noise into the call. You can't do that.
Oh. Is my voice audible?
Voice is audible, but there's a lot more audible what's happening behind you in your room.
Okay. Let me see. 1 minute.
You have to ask them to keep quiet if there are other people in your room, but your slides are on the screen and you can go ahead and start pitching if you're ready. Abdul is from Karachi, Pakistan. I know there's a lot going on in Pakistan. I'm very happy to see you here from Pakistan. I'm interested in what's happening in Pakistan, aside from a completely crazy political situation.
Hello, ma'am. How are you?
I'm good. You want to start? NexuS-Ai?
Yes, ma'am. So basically, ma'am, there is a typo mistake in the pitch deck. It's not Karachi, Pakistan. It's proudly Indian based and UP Kanpur, India based.
UP Kanpur, India based. Okay. All right. So you have moved from Pakistan to UP, India? Is that what is going on?
No. Basically, there is a typo mistake. I live in Kanpur, UP, India, state of India.
Okay. All right. Okay, let's keep going. What are you doing?
So basically, ma'am, I'm Abdul Hadi. I have just built it fast in AI. Basically, India's first one of the, try to create a own Indian AI ecosystem, made in India, built for the world, where we try to create an AI ecosystem in a sustainable and feasible development, not just overpriced, with sustainable development, with security, with privacy focused at best price. So my first project was NexuS-Ai, which is going to be the most badass project in India. You can say there is no other project that we are working. Is the first Indian product that will be becoming the AI OS software of the you can say app development. It's more than Lovable, Bolt, and other companies. You can say a full development kit for no coder platform for founders like you, for founders like me, who don't have a knowledge of a code base, who just have some kind of scattered PRD and etc stuffs. So here you can give a prompt and you can create a full stack app.
So it's a lovable competitor, yeah?
Yeah, basically you can say it's a lovable competitor, but it's more than a lovable. For an idea, you can take as a lovable competitor.
Okay. So where are you in your validation? Or traction? This doesn't even need validation. We already know that there are lots of no-code platforms that are coming out and doing fine in the market. So what is your traction situation? Can we move forward a bit? I would like to.
Yeah. Basically, I want to tell you that currently the AI ecosystem of the current world, like Lovable, these are just a, kind of a folks, and not a you can't create a full production ready application in Lovable and Weatherbolt. After all the development, you require a proper team collaboration to create a scalable and sustainable software. You can create a fun applications on Lovable and Bolt, but what Nexus is mean to complete backend, frontend, and kind of a full stack application in a proper systematic architecture way. you can say agentic based program coding platform, where you have to give a prompt and it will create a whole application in an agentic way, and it's a systematic way where you can collaborate the AI with your actual team agents. And it's lot more than it. It kind of you can say we are trying to integrate a Figma design where you can drop out the components and you can wire up like neon, and it can create a full production ready app. That's a huge badass project.
So what traction do you have? Where is customers? Can we go to customers?
Yeah. So basically, the customer currently we have basically the our main focus on a founders who don't have a technology, who want who want to create their dream project with a foundation level, and later they can give to their team. They can give to anyone who will be responsible for to developing that product as a level. So
Can you
basically, our
advance
main
to
focus
this
is founder.
customer slide, please?
Yeah.
Maureen, could you advance to his customer slide, please? Just advance a bit more. Advance. Do you have somewhere customers?
Yeah, basically, currently it's in kind of, you can say, under development platform, but we have some kind of a, phase zero prototype.
You don't have any customers.
Yeah, we don't have for now any customer because it's not currently in production, but we have some internal testers.
So what brings you here? What are you looking for?
Basically, I was looking for his, guidance and piece of advice because you have a lots of experience as from the, starting of this webinar session. You are sharing some amazing kind of a knowledge. So I want to know that in where I was lacking,
So
and what things I do work.
number one thing that you're lacking is customers. You should not build product without customers in the loop. I want to see immediately you figure out how you're going to position this product and what customers are you going to go after, and go talk to 50 customers immediately. So that is the first thing that you need to do. So if you decide that you want to work within 1M by 1M, that is the direction I'm going to steer you in, is immediately starting to work with customers. Whether you have a product ready or not, it doesn't matter. You have to get customers to tell you whether they want this product or not. You're building in the lab without customers in the loop, and that tends to build products that are not sellable.
Oh, okay. So for that, I want to just add one more thing for this point of particular. Basically, I started creating this product due to some reasons. Basically, I'm on a Telegram community where are 310 members of that community, and they've shared lots of stuff that currently the AI tools that we are working is not that feasible. They are just some front end level, some back end, some front end means kind of scattered everywhere. So I have decided to create a all in one solution. So I have shared idea to Telegram community, and they have loved it, and they say, yeah, okay, so create a product, we will test it out. And that's how. And for the customer view point of, I've already built the Tuesday AI, which have 200 users, reaching the 200 users, all organic without PR.
Okay, so these 200 users are, what are their, what kind of users are they? You know the concept of ICP?
Can you please tell me, ma'am? Basically, it's some.
ICP is ideal customer profile.
Okay.
Who are these people? You have to model who these people are who are resonating with your product. What kind of, this has got to be a B2B product, right? So you need to
Yeah.
understand what kind of B2B customers are they. What companies do they work for? How big is that company? What type of company are they? And really need to, if you have 200 users, you need to understand who these 200 users are. Go to their LinkedIn profiles, each one of them, and try to understand who they are. And we have to derive a whole go-to-market strategy based on this. So we can teach you all of that. Everything that you need to learn to bring your product to market, we can teach you. That is no problem. But you have to join the program to learn all that.
Okay.
Okay?
Okay.
So there is essentially, you are doing software development and you need to learn how to do business development, the venture development, the startup company development. So that part of how to do we actually specialize in teaching techies how to build a business, and we have a full curriculum for that. So what I would advise you to do immediately is to spend about 100 hours just going through the core curriculum of 1M by 1M, and it will give you the full framework of how to build your business.
Case.
All right. So
Okay.
you can come back and ask more questions. Let me work with Kosmas. Maureen, could you step us through to Kosmas's slides, and I will work with him next. Mithun did not turn up. Okay, Kosmas, please go ahead. Oh, Kosmos or Kosmas?
Kosmas.
Okay.
Yeah.
You're in Jakarta. It must be very early or very late.
Very late. Very late. Yeah. This
Okay. Tell us, what do you do?
night.
Thank you for staying up late to do this. Go ahead. Tell us what you're working on.
So yeah, hi, Ramana. So the last year I pitched my deck to you also past year 2024 about mental health, right? So but I'm not really sure that I have I do research about the mental health, and I think I'm not what is it? I think I'm pivoting to the social code. So currently I built a bus. So bus is like social code, like social media, like Instagram or TikTok or something like that, or Twitter or what else. So like social media, but bus is for social code. So the thing is, I want to put social media for positive thoughts. So like every content, every video, or everything in the platform about positivity. I mean about the content is.
Kosmas, does that need to be a new platform, or is it just a channel in an existing platform that is a positive channel? Why do you need to build a new platform?
Because I think there's not filtering in, let's say Instagram, right? Instagram or TikTok. There's no filter about like social abuse or something like that, or hate speech or bullying or something like that, or negative talks. Or
Are you on Facebook?
sorry?
Are you on Facebook?
Yeah.
Okay,
Yeah,
so I want you to look at something on Facebook. I'm pointing you to something. There's a channel called Upworthy. So go look up Upworthy on Facebook and follow Upworthy. There's another one called Margilian, Margilian. These are very positive channels that provide very interesting stories, positive stories, philosophy, all kinds of things that are really positive, really interesting stuff. You don't need to build a platform to build a channel for positivity. You need to build a channel for positivity and then figure out how you make money. I don't know how Upworthy makes money. I don't know how any of these companies make money. But this stuff exists already, and I don't know what those channels are on Instagram or TikTok or Snapchat, but they're there probably if you look, if you research. I don't think building a new social media platform is advisable at this stage of the game. And especially not advisable for people who are not tied into, remember how when we were talking, Gus and I were talking, we were talking about these mega funds, these 30 mega funds that fund these hyperscaler businesses. And that is a very small world in which this kind of funding happens. Unless you are in that league and you have access to that kind of capital, I would not start a new social media platform. It's not, you will not be able to do it. It's very capital intensive, and it's a kind of business that you will not be able to do. You're right, negativity sells. That's what, that's the part of the problem with platforms, social media platforms. They kind of get a lot of traction and engagement around negativity, and that it does sell. But you have to, I think starting a new platform is going to be quite difficult for you. I wouldn't waste time on that. So you figure out something else that you can do in a capital efficient bootstrap manner that fulfills the kind of agenda that you want to work on the kind of inspiration, personal development, positivity agenda that you want to work on, but it cannot be starting a new social media platform. That is not going to work. Okay. All right, Maureen, let's move to the 1M1M section, and then I'll take more questions.
Saramana, before I jump to the next session, so I have a question. So it's not possible to like creating a platform for like motivational quote, right? But this platform for social quote or something like that. Did you have any suggestion or advice?
My suggestion and advice to you is to do the 1M1M curriculum and learn how to build a business. The same advice that I have for Abdul. You guys need to learn how to build a business. So it's not possible for me to teach you that in 2 minutes here, but we do have hundreds and thousands of hours worth of curriculum from which you can learn that. At least spend about 100 hours on the core curriculum and get the basics of, you're going to need to learn positioning, you're going to need to learn validation, you're going to need to learn market sizing, you're going to need to learn bootstrapping, financing, team building, customer acquisition. These are the core building blocks of building a startup, and you need to learn that through a curriculum. Yeah.
But my question is that you are telling to that do this, but main question is that if we don't have a product, how can we create how can we create a business? Because especially if you come to a SaaS product, you have to be a product for to be a business.
No, our philosophy is do not write a line of code without first doing absolute deep customer immersion. So as far as we are concerned, you are much further along. You've already built a product. But if you came to me earlier, I would have told you that you follow the methodology of validating what product to build. At the moment, I'm not confident that you've built a product that people are going to buy. So now we are going to do retroactively, we're going to need to have you do the validation work so that your product is something that people are going to sell. And nonetheless, you're going to have to go through that process. You have to go through the positioning process. You have to go through go-to-market strategy process. All of that stuff that you have to learn. You don't need to have a product to learn these things. In fact, people who learn that first and then start building their product actually do better. But you are now you can still learn and course correct. And if there are problems in what you're building, we need to course correct that in collaboration with customers. You have to go deep into customers right now, and you really need to learn methodology.
Yeah, I will definitely try to learn it. And it's especially kind of for achievement for me at just the age of 16 and 17. I've just passed my high school, and I've just, in 11th class, I have achieved not
Fantastic.
just, yeah,
Congratulations. It's fantastic. That
yeah,
is great.
156 user. And the Tuesday AI product, I didn't much tell you about it, but if you come closer to Tuesday AI, even the world one of the first product that have care about the security perspective. Even if you use chat gpt and cloud AI, these kind of AI companies use your data to train their model and make their better. But in our cases, we use zero data policy, where we use open source model API, so that your chatting data have been secure fully, and it doesn't use for any commercial, selling to other B2B brands and D2C brand for to, show the recommendation and personalization like Facebook ads. So that's how we differentiate from others. And we have, it's made in India product, and it's have a great features like memory personalization, web searches,
But
and the fair
it's not,
token system.
it's you saying having great features does not build a business. Customers have to engage with your product, and you
Yeah,
need
I
to
know it.
you need to learn how to work with customers. That's what I'm saying. So it's great. You're 16, 17 years old. You can go through the curriculum and learn what you need to learn, and I will be delighted to help you get your product to market.
Yeah, it's a very it's a very fantastic thing that we can do. And basically that's what I learned in the Disney means past 2 year journey from techie to understanding the business core concepts. That's why I started watching Shark Tank USA, Shark Tank India, to at least get us some kind of a very basic knowledge. So I have learned about that. If you want to create a product, something really mean to be, you have to be at least a correct validation. Is it solving a problem, or it's just another kind of a copy product? You have to be a correct validation.
Okay, let me finish explaining to you how to use 1M by 1M, and then I'll take more questions if necessary. So Maureen, let's go to everything. By the way, this is a completely virtual program. You can use it from anywhere you want. Kashmir,
Okay.
Indonesia, Kanpur, it doesn't matter. And we also have the digital mind AI mentor, which is also available from anywhere in the world and 24/7. So you start using the AI mentor. That also will teach you a lot of things. Next slide, please. 1M Premium is our full acceleration program where you get this kind of project level mentoring on a weekly basis. You can come every week and talk to me. You also have access to our curriculum. And when you are ready, this is the acceleration program through which we make the investor introductions. But please read the investor introduction policy. You have to be fundable before we introduce you to investors. You can't just join and expect that we're going to send you to investors. Most people would get completely rejected out of hand if we do that. Next slide. You can also join 1M Basic and access the curriculum. To both of you, I'm recommending using the curriculum. So 1M Basic could be a fine entry point for you. And the combination of 1M Basic and AI Mentor could be an option, or 1M Premium could be an option. Whatever you want is fine, but you do need to learn how to build a business. Next slide. Go to the website and look at what to expect from Premium, what to expect from Basic, and decide how you want to work with 1 million by 1 million. Let's move forward, Maureen.
So it is a free program or it's a paid program?
There's no more free program. You just participated in the free program.
Okay,
1M Premium is $1,000 per year. 1M Basic is $9 a month. The AI Mentor is $30 a month. There are 3 free messages, and then it's $30 a month. Next slide, Maureen. So we have one more free roundtable, December 18th, and then January 8th is going to be the first roundtable of the new year. So please, those of you who are listening, if you want a slot, you can only pitch for free once. So you're not supposed to pitch here multiple times for free. This is one-time opportunity. After that, you need to be in the program, the paid program, to use the program. All right, Maureen, next slide. If you have any questions about the program, Irina Patterson is your contact, irina@1mby1m.com. You can contact her. She'll be happy to talk to you by phone, WhatsApp, whatever. Next slide. That is all we have today. If anybody has any other questions, I will answer. Otherwise, we are done with today's session.
Okay, so yeah.
Question? No?
So
Okay.
yeah, so I have last question.
Go ahead.
So
Go ahead.
did you have advice for solo founders, or like?
Yeah, we support solo founders. In 1M by1M, there is no bias against solo founders, but you have to build to traction. Solo founders have to build to traction. I think all founders should build to traction. So our philosophy is bootstrap first, raise money later, and it's okay for you to be a solo founder. You can start putting one foot before the other through the 1M by1M program, no problem.
How many traction need for, let's say, before reach out, should be how many should be
product? What is the business model? If there's no thumb rule like that, you know, B2B has a very different metric than B2C, and we have to understand what is going to be your business model. Right now, you do not have an idea and you do not have a business model, so you need to. In fact, a lot of cases, I think ideation works better when you understand a bit more the methodology of how to build a business, which is why we suggest doing the curriculum, and our curriculum is entirely case study based. So you do the curriculum and the case studies, and you will get much further in ideation than where you are right now. So my stake, as far as you are concerned, Kosmas, is going to be go do the curriculum. So maybe start with 1M basic and start doing the curriculum on your own time. It's just $99 a month. You can do it at your own time. There's no time zone issue, nothing. You can pair that with the AI mentor, which is also 24/7. You can do it at your own time. That's $30 a month. So there are options that you can do on your own without jumping to the $1,000 a year kind of tier. Okay?
Okay, that's all. Thank you.
You're welcome. Anybody else? Any other question? All right, folks, I am going to stop the recording.